Over the past few weeks, something unusual has taken shape in the digital asset market. XRP, a crypto asset that spent years dealing with regulatory uncertainty and mixed sentiment, suddenly saw a wave of institutional capital flow in through newly launched exchange-traded funds. By the end of the month, total inflows crossed $666.6 million, pushing XRP into a space very few altcoins have been able to reach. And for the first time, we're watching institutional demand influence XRP's supply, liquidity, and long-term positioning in a regulated market structure. Today, we're going to break down what's actually happening behind that $666.6 million. We'll look at how these ETFs work, what institutions are doing, how supply is being affected, what risks might be forming below the surface, and what investors should keep an eye on over the next year. And toward the end, we'll cover the bigger picture, what this moment might signal for crypto's future beyond XRP. If you think deep dive content like this matters, feel free to hit the like button. It helps more people see research-driven crypto analysis without the noise. The shift toward regulated access. When XRP first entered the market more than a decade ago, institutional access looked nothing like it does today. Banks, advisors, and funds had limited ways to gain exposure beyond direct token purchases, and those came with custody risk, liquidity concerns, and operational complexity. But ETF structures have changed the way institutions participate in digital assets, and XRP is now part of that shift. These new XRP ETFs allow investors to gain exposure without setting up wallets, managing private keys, or navigating on-chain activity. Instead, they rely on regulated exchanges, traditional brokers, and established custody firms. For large institutions, pension funds, RIAs, asset managers, this structure removes several barriers that prevented participation in the past. A growing number of issuers have now launched or are launching XRP ETFs. Each fund offers different expense ratios, liquidity arrangements, and custodial relationships. What matters most is that these products finally give institutions a familiar vehicle to interact with XRP at scale. But while ETFs open the door, they also create a new dynamic. Inflows directly translate into more XRP being taken off the open market. And that's where the story begins to get interesting. Understanding the $666.6 million surge. Crossing $666.6 million in inflows so quickly is a meaningful signal. ETF inflows reflect real demand, institutions allocating capital through brokerage systems, retirement accounts, and managed portfolios. And because ETF issuers must acquire XRP to match these inflows, the number represents actual buying pressure, not speculative trading. In the first several weeks, total assets under management for the active XRP ETFs climbed to around $800 million, driven by retail advisors, institutional clients, and automated portfolio models adjusting allocations. This amount may not seem huge compared to the largest Bitcoin or Ethereum funds, but for an asset that has only recently entered the ETF market, the scale is noteworthy. The inflows also remove a sizable amount of XRP from circulating supply. ETFs operate on a simple mechanic. New shares require additional underlying XRP. That means every new dollar flowing into these funds results in more tokens being placed into regulated custody, typically with institutions that do not regularly trade or distribute back into the open market. This kind of rapid absorption can create tightening supply conditions, and tightening supply often sets the stage for broader market reactions, which leads into the next major dynamic: demand, supply, and price pressure. As ETF issuers accumulate XRP to match inflows, liquid supply on major exchanges naturally decreases. This is a familiar pattern that played out with Bitcoin ETFs earlier in the year. When a steady stream of demand meets a shrinking pool of available tokens, market structure begins to shift. If these inflows continue, XRP could experience supply-side pressure that increases sensitivity to even modest buying volume. A handful of ETFs holding hundreds of millions in XRP creates structural demand that didn't exist before. Meanwhile, institutional investors tend to hold positions longer than short-term traders, which slows supply returning to the market. That doesn't automatically mean price rises linearly, but it does introduce upward pressure that wasn't present before ETF adoption. And for long-watching XRP holders, this could represent a new phase where institutional positioning becomes a core driver of market behavior. If you want more updates like this as they unfold, feel free to subscribe. We break down institutional movements in real time without the hype. Despite these positive signals, the story isn't complete without understanding who's actually driving the flows and how competitive the landscape is becoming. Who's behind the inflows? Several issuers stepped into the market at once, and each is capturing a segment of investor demand. Some of the early leaders have seen strong day-one volume and consistent inflows from both retail advisors and institutional accounts. Others are positioning themselves as lower-cost options or leaning on their reputation for managing other crypto ETFs. Each issuer uses slightly different custodial partners and internal structures. Some rely on major custody institutions known for managing billions in digital assets, while others use hybrid models that combine internal trading teams with external custody providers. These differences influence liquidity, spreads, and tracking accuracy, all factors that affect long-term investor confidence. What's most notable is the speed at which competition has grown. When multiple issuers enter a market simultaneously, they tend to push each other toward lower fees, tighter spreads, and greater transparency. For investors, that typically results in a more efficient and accessible market. Still, even with healthy competition, the real importance lies in what the presence of these issuers signals. XRP has graduated from being a niche asset, discussed mostly in retail communities, to one that traditional financial institutions are now willing to package, manage, and distribute. This shift ties directly into the broader crypto environment, which is evolving just as quickly. The bigger market context. XRP's ETF launch happened during a period when digital asset markets are moving steadily toward institutionalization. Bitcoin and Ethereum opened the door, but most altcoins have not reached a scale large enough to support ETF demand. XRP's entrance into this category sets a new precedent. For the broader market, this moment suggests that institutional capital is ready to expand beyond the two largest assets. Advisors who typically allocate 1 to 3% to crypto exposure are now adjusting models to include more diversified offerings. Some are adding XRP as a payments-focused asset, while others view it as a strategic hedge within a broader crypto basket. The inflow velocity, how quickly money enters a new ETF, is also significant. It indicates that investor interest existed before the product launched. These inflows didn't materialize out of thin air. They came from waiting demand that finally had a regulated path to enter. This environment raises new questions about how capital will distribute across digital assets over time. And it sets the stage for a more complex marketplace where altcoins compete for institutional mindshare, not just retail attention. To fully understand the landscape, though, we need to examine the risks that come with increased institutional involvement. Understanding the risks. While ETF inflows create stability for some investors, they also come with structural risks that shouldn't be overlooked. One of the first concerns is concentration risk. When a handful of issuers control a significant portion of circulating XRP, the ecosystem becomes sensitive to their operational and financial decisions. If an issuer experiences internal issues, changes custodial partners, or faces regulatory action, the effects could ripple through the market quickly. That's not unique to XRP, it's simply a byproduct of institutionalization, but it's worth keeping in mind. There's also the matter of volatility. A reduced liquid supply means markets can move more sharply on less volume. While inflows can push prices steadily upward, outflows from ETF redemptions have the potential to cause equally strong downward moves if sentiment shifts. Macro conditions matter too. If interest rates rise, or if risk appetite declines across equities and bonds, ETF inflows can see reduced inflows or even reversals. And because ETF inflows now play a central role in XRP's price behavior, macro pressure will have a more direct influence compared to past cycles. Finally, speculative behavior is a long-standing risk in all digital assets. If ETF growth doesn't align with real utility growth, such as increased network usage, partnerships, or payment volumes, the market could become overly reliant on financial products rather than organic demand. These risks don't negate the progress, they simply provide a realistic foundation for understanding what comes next. Metrics worth watching. For anyone monitoring XRP in this new environment, a few indicators now matter more than ever. The first is ETF inflows and outflows. These numbers reveal real-time institutional sentiment. Growing inflows indicate increased allocation, outflows suggest shifting risk tolerance. Watching exchange reserves is equally important. A steady decline in XRP held on major exchanges signals supply tightening. If reserves continue dropping while ETF inflows rise, the market environment becomes structurally bullish, but also more sensitive to volatility. Investors should also monitor on-chain activity, particularly transaction volume and wallet growth. If these measures rise alongside ETF adoption, it suggests utility is growing in parallel with investment. If on-chain activity remains flat, it may indicate that financial demand is outpacing real-world use. Macro conditions round out the picture. Interest rates, liquidity cycles, and regulatory updates can all influence how advisors and institutions allocate to crypto. As XRP becomes more tied to traditional markets, these external factors carry more weight.
The next 6 to 12 months. If current inflow trends continue, the next year could bring several possible outcomes. In the first scenario, ETF assets continue to grow as more advisors and institutions add XRP to diversified crypto allocations. In this environment, supply would tighten further, potentially creating upward pressure on price. Market sentiment would likely improve as ETF adoption becomes a steady force, rather than a short-lived spike. A second scenario involves slower inflows or a pause in demand. This could happen if macro conditions shift, regulatory questions reemerge, or if the market experiences a broader downturn. In this case, price stability would depend on whether investor issuers maintain their positions or begin reducing holdings in response to investor withdrawals. A third scenario involves more ETF issuers entering the market, expanding competition and potentially driving fees lower. Lower costs often attract more capital over time, especially from long-term investors seeking broad exposure. And in a broader sense, the presence of these XRP ETFs may encourage other institutions to create related products, such as derivatives, covered call funds, or multi-asset crypto portfolios. As XRP integrates deeper into traditional markets, its price behavior may begin to resemble that of established financial assets, shaped by flows, liquidity cycles, and portfolio construction strategies. All of these outcomes highlight the same underlying theme. XRP's market structure is entering a new phase that looks fundamentally different from its past. The milestone of $666.6 million in ETF inflows marks more than just a number. It reflects a shift in how XRP is perceived and accessed within traditional finance. Institutions now have a regulated, reliable, and scalable way to gain exposure, and they've acted quickly to take advantage of that opportunity. This move has tightened supply, increased market credibility, and positioned XRP alongside a small group of digital assets capable of supporting ETF-level demand. But it also introduces new dependencies and risks that come with institutionalization, requiring investors to stay aware of shifting conditions. Over the next year, XRP will be shaped not just by price action, but by flows, adoption trends, macro pressures, and ETF behavior. Whether this moment becomes a long-term turning point or a temporary surge will depend on how these forces interact. If you want more research-driven updates like this, feel free to subscribe and leave a comment with the next topic you want covered. Your feedback helps shape what we explore next.